What happens when an entire economy believes that housing prices will never fall? When that belief spreads from ordinary families to massive financial corporations? From quiet suburban streets to the buzzing heart of Wall Street? Is it a sign of prosperity or the beginning of a disaster? After 2001, America entered a period that seemed stable on the surface, but was actually incredibly fragile underneath. Two major events shook the world: the collapse of the dot-com bubble and the September 11th terrorist attacks, sending the U.S. economy into turmoil. Young tech companies lost billions of U.S. dollars in value, hundreds of thousands of people lost their jobs, and fear, uncertainty, and recession quietly seeped into the mindset of consumers. In response, the U.S. Federal Reserve, under the leadership of Alan Greenspan, took a drastic step. It cut interest rates down to nearly zero. The goal was simple: to encourage spending, stimulate investment, and help the economy recover. Money became cheaper than ever before. Borrowing no longer felt like a burden. It suddenly looked like an opportunity. But sometimes, the very policies meant to save an economy end up planting the seeds of the next crisis. Amid this backdrop, the American dream, especially the dream of owning a home, was glorified like never before. The slogan, "Why rent when you can own?" echoed everywhere, from TV commercials to street billboards. Buying a house was no longer just about having a place to live. It was a symbol of success, of status, of the dream that America proudly sold to the world. Banks and financial institutions quickly caught on. They started loosening lending standards to attract more borrowers. Mortgages were handed out with shocking ease. No down payment, no proof of income, not even proof of employment. The infamous ninja loans: no income, no job, no assets. A part-time worker with a modest paycheck could buy a house worth hundreds of thousands of U.S. dollars with just a few signatures. These loans came with teaser interest rates, low at first, then rising after a few years. Many borrowers didn't really understand how that worked, or they assumed that before the rates went up, they could simply sell the house for a profit. This mindset spread fast, fueling one of the biggest real estate speculation frenzies in modern American history. People weren't buying homes to live in anymore. They were buying them to flip. Buy today, sell a few months later, pocket tens of thousands in profit. In states like California, Florida, and Nevada, housing prices were rising 20 to 30% a year. Newspapers celebrated weekend investors who became millionaires just by trading homes. Everyone believed that home prices always go up, an unbreakable law of nature it seemed. But behind that glittering dream was a financial time bomb being quietly armed. When too many people borrow under easy conditions, the financial system starts relying more on faith than on fundamentals. Banks believed borrowers would repay because housing prices would keep rising. Borrowers believed they didn't need to repay fully because they could resell for more. And the market as a whole believed that no one could lose in this game. The housing boom didn't just inflate property values, it reshaped America's financial culture. Home ownership became the measure of success. Reality TV shows like Flip This House and Property Ladder encouraged ordinary people to dive into speculation. Some even took out a loan from one bank to pay another, stacking debt on top of debt without thinking about what would happen if the music stopped. Meanwhile, the banks themselves were playing an even more dangerous game. They weren't just making loans. They were selling those loans to larger financial firms, which bundled them into complex investment packages. It was a way to move the risk off the books. But ironically, that very process ended up spreading risk throughout the entire financial system. By 2004 to 2006, U.S. housing prices hit record highs. In many areas, a home's value doubled within just a few years. People believed it was a golden age for America, proof of a miraculous comeback after the dot-com crash. Politicians praised what they called the ownership society, where every citizen could own a piece of the dream. But the truth was harsh. The foundation of that dream wasn't savings, it was debt. Personal debt, bank debt, and system-wide financial debt. Each subprime mortgage was like a loose brick in a massive tower, and when enough loose bricks piled up, it only took a tiny shake for the whole structure to collapse. By the mid-2000s, a few experts began warning about a housing bubble. But in an economy where everyone was making money, no one wanted to hear bad news. Home prices can't fall nationwide, one economist famously declared in 2005, a statement that now stands as a monument to blind faith. Then by mid-2007, the first cracks began to appear. Some borrowers couldn't keep up with their payments once the adjustable interest rates kicked in. Foreclosed houses started showing up more often in suburban neighborhoods. But what few realized was that these were merely the first tremors before the greatest financial earthquake of the 21st century. While ordinary Americans were intoxicated by the housing boom, Wall Street was playing a different kind of game, one far more complex, sophisticated, and dangerously deceptive. If home buyers were playing with fire, then the investment banks, hedge funds, and global financial institutions were pouring gasoline on that fire through a new generation of financial instruments known as MBS, CDO, and CDS. To understand how this all worked, we have to start with something that sounds simple, but is actually incredibly intricate. Mortgage-backed securities, or MBS for short. Commercial banks, after issuing millions of home loans, didn't want to hold on to them for long. Holding them meant taking on risk. If borrowers defaulted, the banks would lose money. So instead, they sold these loans to bigger investment institutions, usually Wall Street banks or specialized financial firms. Those firms would bundle thousands of these mortgages together, creating a brand new product, the MBS. These mortgage-backed securities were then sold to investors around the world, pension funds, insurance companies, and even foreign banks, as if they were safe, stable assets. After all, they were backed by something tangible, American homes. On paper, it seemed bulletproof. If a borrower defaulted, the lender could repossess the house and sell it again. A flawless system, right? Except in reality, it was anything but. The so-called safe MBS packages were stuffed with subprime loans, risky mortgages handed to borrowers with poor credit or unstable income, mixed together with prime loans as if there were no difference at all. What made it worse was the role of credit rating agencies, the supposed referees of the financial world, like Moody's, Standard & Poor's, and Fitch. These agencies were paid by the same investment banks that created the products they rated, a huge conflict of interest. As a result, even bundles full of toxic subprime loans often received the highest rating possible, AAA supposedly as safe as U.S. Treasury bonds. This gave everyone a false sense of security. Pension funds for teachers, nurses, and retirees poured billions into these products, convinced they were buying low-risk investments. No one realized that buried inside these glossy packages were thousands of ticking time bombs. Borrowers who couldn't possibly repay their loans. But Wall Street wasn't finished yet. Once MBS took off, the banks invented something even more complicated: collateralized debt obligations, or CDOs. If an MBS was a bundle of mortgages, then a CDO was a bundle of MBS, a kind of meta-investment sliced into layers, called tranches, based on how risky each portion was. The top layer, the senior tranche, was considered safe because it would only lose money if all the layers below it collapsed. The middle layer, called mezzanine, and the bottom, called equity, were riskier but paid higher returns. It sounded logical, a clever way to spread risk, but it was actually an illusion of safety. The mathematical models used to price CDOs all assumed that home prices would never fall nationwide and that defaults would happen only in isolated pockets. Reality, as history proved, had other plans. These CDOs were seen as financial alchemy, turning bad debt into gold-plated investment assets. They were sold all over the world, from London to Tokyo, from German banks to hedge funds in Singapore. The more CDOs they sold, the more incentive there was to issue new mortgages, even to people who clearly couldn't repay them. The financial market had effectively turned into a debt production factory, where risk didn't disappear. It was simply repackaged and redistributed. Still, a few sharp minds saw what was coming. They realized the bubble was inflating to the breaking point, and they wanted to bet against it. That's when another product entered the scene: credit default swaps, or CDS, contracts designed to insure against credit risk. In theory, a CDS worked like an insurance policy. If you owned an MBS or CDO and feared it might default, you could buy a CDS to protect yourself. If the bond failed, the seller of the CDS would compensate you. But here's the absurd part. You didn't need to actually own the asset to buy a CDS. Anyone could wager on the collapse of any mortgage package, just like betting that a house you don't own will burn down. Speculators, like Michael Burry's hedge fund and the investors later depicted in The Big Short, started buying up CDS contracts to short the housing market, betting it would crash. Meanwhile, banks like AIG, Goldman Sachs, and Lehman Brothers sold these swaps as if they were easy profit machines, believing that the U.S. housing market was simply too big to fail. But every time someone bought a CDS, system-wide risk multiplied. There was no central authority regulating these contracts, no capital requirements, no oversight. They were traded in the shadows, over the counter, meaning directly between parties, outside of any exchange. No one really knew who owed what to whom, or how massive the total exposure had become. It was like a global spiderweb of bets. One wrong move, and the entire web could snap. By 2006 to 2007, Wall Street had effectively become a giant casino. Financial institutions were not only the players, they were also the dealers, the house, and the insurers, all at once. They borrowed staggering amounts of money to keep gambling, using financial leverage that was 20 to 30 times their actual capital. That meant even a drop of just 3 to 5% in asset values could wipe them out completely. Yet in the frenzy of record profits, no one wanted to stop. Bank executives took home multi-million-dollar bonuses as long as short-term revenues kept rising. Analysts were rewarded for inventing more exotic financial products, repackaging bad debt into what looked like high-grade investments. Wall Street truly believed it had reinvented how money worked, but in reality, it had built a castle made of sand. And then the cracks appeared. At the very bottom of the pyramid, among the subprime borrowers, defaults began to spike. Those tremors quickly rippled upward. Since every MBS and CDO was ultimately backed by the same fragile foundation, the belief that home prices would always rise, once that belief shattered, the math stopped working. Within months, the entire system began to crumble.